Tell me what you think Jay Powell is going to say, and how concerned are you about runaway growth this year? And the question is whether the runaway growth this year is sustainable next year, and how you think he thinks about that.
So, I think it's an interesting dynamic that we have playing right now. The Fed is very happy with the current situation, right? And the market's kind of doing its job for it. When you sit back and you look at what the Fed has been able to engineer, it's quite remarkable. So they've had inflation break-evens accelerate. They've had some of the froth taken out of the spec tech trade without having to do anything from a macroprudential perspective or from a monetary perspective. At the same time, real yields haven't really increased. And that's, of course, what the Fed is focused on, because real yields or an increase in real yields are what can stimulate economic growth. And ultimately, at the end of the day, Chair Powell and the rest of the Fed, I think, are very happy to let the economy run hot. And that's really their end goal. And so they're going to push traders, push the economy, push inflation to the point where, they have to step in. They want to get to the point where the market's begging them to hike rates. And we're not there yet. So basically what I think is going to happen is, Powell's going to be just as dovish as he has been. I think the committee is likely to be just as dovish as they have. Certainly not the long-term projection of DOT. So currently at 2.5% as the median projection of their neutral rate. That is unlikely to change. And in terms of the economy and growth accelerating, certainly in 2021, that's the case.
Mike, I think we're taking hits on your sound there for a second. I'm going to go back to Ingrid. We were just talking about growth in 2021. Goldman Sachs, Ingrid, is saying that they think that growth could get to 7% by the end of the year. My question is what you think 2022 and beyond looks like, and whether you think, obviously 7% won't be sustainable, but what a base level actually looks like.
We think we probably return to the more slower growth environment that we were in pre-pandemic. And I think the importance of trying to find secular growth really stands true, because you don't want to buy businesses that are just tied to where we are in the macro cycle, given how hard that is to predict. And if you can find companies that are participating in these large trends, and clearly as sustainable investors, there are many that are highly investable. The electrification of vehicles, the greening of transportation, the digitization of the economy, and then use opportunities, as we've seen that the market continually gives us, with volatility, to buy these really high quality businesses that have long tailwinds.
But let me ask you a question. You talked about the electrification of the vehicle market. And obviously that is a real and meaningful trend, and it's going to move in that direction, no question. The question I have is, if you add up the valuations of all of the automakers in the world right now, it's at a significantly higher valuation across the board than historically the entire auto market normally would be. I look at this market and say to myself, isn't this just effectively one kind of vehicle replacing another kind of vehicle? Am I wrong? And I'm not taking take the oil market and the fuel market out of it for a second.
Yeah, fair point. But you don't have to own the automakers to participate in electrification. You can own Texas Instruments, the analog chip maker, or Aptiv, the electrical architecture. So the componentry, which is gaining dollar share of the automobile wallet. And so we think more holistically. We look at these macro trends and we try to find companies that can participate, not necessarily buying a high-flying name that everybody associates with electrification.
Right. Okay, final word to Mike, because we lost your sound for a second. You were talking about growth at the end of 2021, pushing into 22, I think, is where we might have left you.
Yeah, I was. I think growth is likely to accelerate throughout 2021 into 2022. And as we get closer to full employment, what that means is a higher rate environment. So to Ingrid's point, sort of the high flying tech is likely going to get hurt by that. It's a long duration trade. You want a short duration portfolio. That means you want to be, underweight treasuries, generally speaking. You want to be in higher credit risk type products like high yield. You want to be in value and small caps and names in the equity side that are going to show real profits growth, right? And I think, we can expect that we're going to be in a strong growth environment this year, next year, and quite frankly, probably for the foreseeable future over the next several years. I mean, there's no reason to expect that growth isn't going to continue to accelerate. Rates aren't going to continue to go up. The curve is going to continue to steepen over the next several years, unless the Fed does something silly and hike rates aggressively, which I just don't see happening.
Shepard Smith here. Thanks for watching CNBC on YouTube.